What is the highest returns you've made in a single year?
It was up more than 100%.
Wow.
With experience, I've learned one very big investing lesson, Sharan, that even though it may be a great business, if that company is operating in an industry which is not enjoying a sectoral tailwind, you will not make money. Since 2020, governments across the world have become all too powerful, and now they are determining the winners and losers of each bull market cycle. If you are able to invest in industries which are having this focus of the government as well, you can make a lot of money. For example,
What are the sectors that I should look at, which you have analyzed?
if you want to be successful as an investor, Sharan, you have to make friends with the word new. How do you understand if a business is a high quality business? It has to have three characteristics. Number one. Secondly, third and most important,
One asset class you would completely avoid right now.
if you had asked me this question in January, I would have mentioned gold and silver because there was complete euphoria.
So now gold and silver is still okay or no?
I think
Mr. Gautam, welcome to the 1% Club show.
Thank you for having me, Sharan.
Gautam, it's not every day that, I have a personality whose book has been written by none other than Mr. Warren Buffett. So can you tell me what is the book that you have written and how did Mr. Warren Buffett ended up reading it and talking about it, making it a global phenomenon?
So, Steve Jobs has very famously said that you cannot connect the dots, looking forward, but you can connect the dots looking backward. I had a habit of documenting, all the great articles and content that I was reading and collating all of that into a Word document for many years. I had this habit of just collating very good content. I already had the material ready with me, so I thought, why don't I just self-publish this, and it may help a few people, and I may also come in touch with like-minded people in the value investing sphere. So that was, how I self-published the first edition of The Joys of Compounding. And at that particular point of time in 2018, I thought probably it will sell a few hundred copies, and I may get in touch with a few good like-minded people in the investing community. But the book took off. It sold a lot in US and Canada. Being a value investor, it was always a dream. It's always a dream for us to get published by Columbia Business School someday, because that is where the discipline of value investing originated. Benjamin Graham, who's the father of value investing, he used to teach value investing in Columbia University only.
And you and Warren Buffett studied there.
Yes, under Benjamin Graham. But but Columbia had a very big condition. They said, you have included a lot of copyrighted content from Warren Buffett's annual letters in your self-published book. But in order for us to publish your work and distribute it across the world, you need to get formal written permission from Buffett himself that he's okay with you sharing his content in your book. So I said, how will that be possible? Why would he approve my request? He gets hundreds and thousands of such requests frequently. Why would he approve my request? But that was a hard condition. I still just published printed out the manuscript of my book, and I wrote a very emotional, heartfelt letter to him. And wonder of wonders, not only did Warren Buffett approve me using his copyrighted content from his shareholder letters in my book, he also wrote separately a handwritten note to me in which he praised the Joys of Compounding. He said that this book deserves success. And when I put that letter picture on Twitter, it just exploded. It just went viral, and that made the book very much high profile in the investing community. And the rest is history. Today, the book is an international bestseller in 9 countries around the world.
Wow. And how many copies has it sold?
Around about 100,000 copies in 6 years.
100,000 copies has been sold. Wow. All over the world.
Around the world, yes.
Wow. So let's talk about what exactly did you write in that book, which made it so popular. But before I get into that, I want to talk about some quick numbers to sort of understand what kind of money you manage, because you are actually a fund manager right now. So what is the amount of money that you manage, and what is your performance been like in the last few years? If you could reveal that, please.
So I'm the founder and fund manager of Stellar Wealth Partners India Fund. It's a US-based hedge fund. It's based out of Delaware State, and I accept capital from accredited investors in the US.
What is the minimum investment size to get?
Yes, the minimum ticket size is $250,000 from accredited investors in the US, and I invest that capital into the Indian stock markets. I've been investing in the Indian market since December 2007. And for the last 18 years, this has been my biggest personal passion. For me, this is more than just making money. It's just a intellectual pursuit of just gaining constant wisdom and just trying to figure things out all the time. So I just find it very, very interesting. The fund went live on 3rd October 2022. And in the first 3.5 years, as of 15th of April, the fund has delivered a net return in INR of 92% after a performance fees. And if you look at it in USD, it's you can reduce the rupee depreciation of 15-16%. That is the net USD return performance so far. And this includes the full impact of the bear market in India small cap mid caps from September 2024 till 31st March 2026.
Wow. And if I had to put a CAGR number to it, what would that be?
In INR, it would be 21%. In USD, it would be probably a few percentage points lower.
Wow. Wow. So not everybody has 2.5 crores to invest, because you said minimum $250,000 to invest in this fund. So for the people watching over here, let's begin the process of investing as per how you invest this money. How do you invest money? Let's say you have 1 crore to invest. How do you think about allocating this capital?
So at Stellarwell Partners, we follow a investment philosophy which is based on 2 key pillars. Number 1, focus on quality of the business, and number 2, focus on quality of the management. And the second pillar is a focus on prudent diversification. I'll talk about all these aspects one by one, but first let me talk about what does prudent diversification mean. At any point of time, we hold between 20 to 25 stocks, diversified across industries and risk factors to avoid single factor risk. We are flexi cap fund, we are market cap agnostic, sector agnostic. We invest wherever we find opportunity. And new stocks are purchased with a weight between 3 to 5%, and subsequently average upwards if the management executes above my personal expectations. Individual stock level exposure limits are capped at 15% of AUM, and individual sector level exposure limits are capped at 30% of AUM, again to avoid single factor risk. This is about the diversification aspect. So now I'll talk about the quality aspect, quality of business, quality of management. How do you understand if a business is a high quality business? It has to have 3 characteristics. Number 1, it has to have a return on capital, which is more than the cost of capital. That gives you the free cash flow yield. Secondly, there has to be some form of a competitive advantage, or what we call a moat, which sustains this spread of the return on capital over cost of capital for a long period of time. And third, and most important, the business has to have sufficient reinvestment potential or opportunities within the company at high returns on capital. That is how you get a compounding machine. There are many consumer companies in India, for example, Nestle, HUL, they have very high returns on capital, but they are unable to reinvest that capital back into the business at high ROIC. So they have to pay out large dividends. So high dividend yield stocks are good for preserving wealth, but to create very large amount of wealth over the long run, you need a compounding machine. That is where you have to focus on. So this is about quality of the business. Now, how do I understand the quality of the management? So for many of my US citizen investors in my fund, and they ask me, Gautam, you live in and work in the US, how are you able to assess management quality while being based out of a different geography? So Warren Buffett again has a very good advice here. He has said that the best predictor of the future performance is the past track record. So first of all, you check whether the company has been able to grab market share from its competitors. The lesser the competition, the better. And has it been able to grow over the last 5-10 years without resorting to equity dilution or without having to raise debt? If it can have very healthy organic revenue growth, not inorganic, not M&A led, without having to resort to external capital, and if it can fund everything with internal accruals, that's a very high quality business. Also check the stability and consistency of the operating margins over the last 5 to 10 years. If it's too volatile, you'll understand it's a cyclical business. It doesn't have too much pricing power. It only has pricing power in good industry times. But if it's consistent across market cycles over the last 10 years, then you know that this business has to have some form of a competitive advantage, and it has pricing power, it has stability in its business. Those are the kind of businesses you want to basically back.
I would like to ask you, do you do this from a bottom-up or a top-down approach? Do all of this analysis?
It's both. It's a combination of both. I'll tell you why. Earlier, I used to be more of a bottom-up investor, but over time, with experience, I've learned one very big investing lesson, Sharan, that even though it may be a great business, in terms of management quality and past track record, if that company is operating in an industry which is not enjoying a sectoral tailwind, you will not make money. So basically, if you invest in, for example, Uber real estate or Lodha developers or other big companies like DLF in a real estate down cycle, even though these are, pretty well established companies, you will not make money. So you have to go top down. You have to look at whether the industry is actually enjoying a push or support from the government as well. Because after COVID, what has happened is, since 2020, governments across the world have become all too powerful. And now they are determining the winners and losers of each bull market cycle. So
wait. You're saying after COVID, governments have become all too powerful.
all too powerful.
Can you explain that?
So basically, governments have, basically because earlier most of the liquidity used to be infused by central banks through monetary policy, but after COVID, governments across the world engaged in fiscal fiscal stimulus. So now they introduce tax breaks. For example, if I talk about the Indian government, for example, in 2025. Indian government put in fiscal stimulus through making income up to 12 lakh rupees tax-free in the budget last year. They also rationalized and reduced the GST rates. That was a fiscal stimulus, again from the government side on indirect taxes. So government is basically now, if you are able to invest in industries which are having this focus of the government as well, you can make a lot of money. For example, from April 2020 to September 2024, the focus of the government of India was on boosting government capex. So you saw a flurry of multi-baggers coming from industries like solar, renewable energy, smart meters, and railways, defense, PSU companies. Basically, you have to closely follow where the government is putting its energy and focus. But since last year, in the last 12 months, a very distinct shift has happened. Now, if you just combine the multiple measures taken by the government, be it the income tax cuts or the GST cuts, or the interest rate cuts from the RBI, it's very clear that now the government is focusing on boosting domestic consumption. So you have to that's why you have seen a derating of many of these government capex-led stocks. Even though those stocks may continue to give good earnings numbers, but the stocks are undergoing valuation derating, and that can be a very, very painful exercise for an investor.
So let us do that exercise right now, right? I'm sure you do this every day. But let us start from level 0. Let us say today you have 100 crores of a fund and you have to do this exercise right now on what are those industries and sectors from both a bottom-up and a top-down approach which you will want to invest in. So can you do that step by step in front of us right now?
First of all, you have to before I talk about the sectors and themes which can do very well, you have to understand which stage of the market cycle we are in. That's very most important for active fund managers. I personally believe that India has entered stage 1 of a new bull market, and I'll explain why. Later on, we can discuss, the various stages of a bull market and a bear market. Every bull market goes through 3 stages, and every bear market goes through 3 stages. And this is based on, actual, research and the study of past market cycles. I've come to a conclusion that you have to understand which stage of the market cycle are you in. So in stage 1 of a bull market, what happens, Sharan, is the most beaten down stocks of the just concluded bear market tend to bounce the hardest. So in the last 3 weeks, just look at the kind of stocks which have gone up the most: Reliance Power, Jai Prakash Power, Galant Ispat, Electra Green Tech, and many SME companies which had gone down 90%. Even they have gone up 30-40% in the last few weeks. And in stage 1 of a new bull market, what's going to happen is, these companies of the stocks which were displaying the maximum relative strength towards the end of the bear market. Relative strength means that those stocks are not falling much when the rest of the market is falling towards the end of the bear market.
Yeah.
But because those stocks did not fall much to begin with, they don't go up too sharply in the stage 1 of the of the new bull market. So basically, the new sectoral leaders reveal themselves just as a bear market is ending, but they do not go up very sharply in the stage 1 of a bull market. Once stage 1 of a bull market gets over, then you go on to stage 2.
So just to summarize, stage 1 is when the companies which have fallen a lot during the last phase of the bear market have
the lower quality businesses.
The lower quality businesses have gone up very fast. That is stage 1 of the bull market.
That is stage 1 of a bull market. Basically, in this particular phase, all businesses, good and bad, go up rapidly. There's a broad-based recovery
This is stage 2 now.
This is stage 1.
This is stage 1.
Stage 1. This is this is stage 1 in which many people think who have bought those low quality businesses or those stocks which crashed the most in the previous bear market. They think that okay, now we'll get back our capital. But just if you do the math, if something falls from 100 to 20. Even if it goes up 40%, you're still at 28. You're still down 72%, right? But it raises false hope among many investors. This, instead of rotating capital from those losers into the new sectoral leaders, they still tend to hang on to the past losers. That is the mistake which you should not do. The active fund managers or the active investors, we tend to do what is called switching within the portfolio. So towards the end of a bear market, we switch from the laggards or the weaker businesses which have now been identified into the new stocks or the new businesses which are showing relative strength. And then you basically reshuffle your portfolio and move into those kind of businesses. Those businesses go up, like for example, in the last 2 weeks, small cap, mid cap index in India has gone up 15%. So your high relative strength stocks from the previous bear market, they have also gone up by 14-15% only. They have not gone up 40-50% because they did not fall too much to begin with. But they bear fruit in stage 2. The stage 2 of a bull market is when active stock pickers really shine. This is the longest phase of any bull market. So once stage 1 gets over, then the market starts becoming narrow. The market starts to differentiate, and it rewards strong earnings growth and management, growth visibility, good commentary very handsomely in stage 2. This is where active stock pickers get handsomely rewarded in stage 2. This phase lasts the longest.
Have we reached that stage yet?
No. We are right now in stage 1 because
I'm
everything
already enjoying stage 1 in my portfolio.
It's stage 1 right now. It's basically right now. But stage 2 is the phase which runs the longest. Basically, this is the longest phase of a bull market. And this particular stage 2 of a bull market, is characterized by sectoral rotation. So basically, every new bull market has got a new set of sectoral leaders. There are 3-4 sectoral leaders in every bull market. For example, in 2003 to 2007 bull market, you had real estate, infrastructure, commodities, organized retail. In stage 2, what happens is stocks from one leader go up for a few months. Then they pass on the baton to the next sector, and then stocks from that particular sector starts going up. All of them do not go up together. So suppose you have a portfolio of 20 stocks from these new bull market leading sectors. You will notice that for the initial few months, a certain group of stocks from a single industry are going up while the others are resting. Then after a few months, a new set of stocks from industry number 2, the leading industry 2, they start rising. So basically, it's a kind of passing the baton from one sector to the other. This is stage 2. Market is narrow, and sectoral rotation keeps on taking place after certain intervals. And then we enter stage 3 of the bull market. This is when basically there are certain indicators which will come to your view. If there is a record issuance of QIP. QIP means qualified institutional placement or insider stake sales. 2023 calendar year, India had the largest amount of QIPs on record, 53,000 crores.
So what does that mean? Qualified institutional?
Basically, the promoters or the founding members of the company or the private equity players, they sell some stake in the secondary market to mutual funds and other institutional buyers. It's basically insiders reducing their stake to take advantage of the...
Basically, insiders cashing out a little bit.
Cashing out to take advantage of the, euphoric market conditions.
Yeah.
So, you have to have certain indicators in place to understand as a fund manager that the bull market is about to come to an end. This pattern has repeated multiple times in the past, but I'll talk about the most recent example. So from April 2020 to October 2021, we had a bull run. From November 2021 till March 2023, we had a bear market. From April 2023 till September 2024, again 1.5 years. You see, there's a pattern here. 1.5 years, we had a bull run. And then from September 2024 to 2nd April 2026, we had a bear run. Yes. 1.5 years it's happening. So how could you have assessed in August or September 2024 that that particular bull market is about to come to an end?
Yeah.
There's a combination of data points and indicators which you have to use together. So in 2023 calendar year, we had QIP or insider stake sales of 53,000 crores. This went up to 1 lakh crores in calendar year 2024. You combine that with the fact that in calendar year 2024, Indian markets world over globally had the largest amount of IPOs by value. So the value of IPOs in the Indian market was the largest in the world in calendar year 2024. So what is that? That again indicate
frenzy.
There's a lot of euphoria and frenzy. People are being able to raise money very easily. So you combine these two factors: secondary sales in the secondary market through QIPs, and promoter stake sales through IPOs in the primary market. Okay, secondary market, primary market, both are on fire. along with this, you add a third indicator. This is most important. Look at the quality of IPOs coming to the market. So in this stage 3, as the bull market is about to come to an end, you'll see companies with very dubious business quality or lack of any business coming to the market to raise money, especially in the SME exchange, and they'll get oversubscribed in a very big way. For example, in late August 2024, there was a company called Resource Automobile. It was the poster boy of the previous SME bull market. This company used to just have 2 Yamaha dealerships in Delhi, and they wanted to raise 12 crore rupees from the market. Basically next to nothing business, but they still tapped the market to raise 12 crores. And the IPO was oversubscribed 200 times. There was demand for almost 2,500 crores for a company having 2 Yamaha dealerships. That should have set the alarm bells ringing as an active fund manager. Okay, we are in stage 3. Now something very bad is about to happen. You'll also suddenly notice that every day, almost for many weeks in a row, almost all the stocks in your portfolio, across sectors, across quality, across market caps, everything is going up together rapidly at the same time together.
Momentum.
There's complete euphoria.
Yeah.
This is how you know that you're about to enter into a very brutal bear market. It's going to happen anytime. Then and after this, there's a transition. There's a transition phase from phase 3 of a bull market or stage 3 of a bull market to stage 1 of a bear market. During and how will you catch that transition as an active stock picker? You'll start noticing, Sharan, in October and November 2024, just as the previous bull run was coming to an end, you'll notice that stocks suddenly stopped responding to good earnings and results. Good earnings, good results, stocks stopped going up. They started actually falling or staying flat even after good earnings growth in October and November 2024. This is the phase, you're about to transition into stage 1 of the bear market. Stage 1 of the bear market, most recent bear market, took place in January, February, March of 2025. There was a big fall, 20% fall in the small cap, mid cap index. And there was a fall of 25-30% in many SME stocks, many small cap, mid cap stocks. But stage 1 of a bear market is characterized by buy the dip mentality. There is no fear as such, because the previous bull market has just ended a few months ago. People are thinking that this is just another routine correction, just a random routine fall in stock prices. It'll again come back, because a bull market always climbs wall of worry, and dips in bull markets are bought and they again recover back and go to all-time highs. But in a stage 1 of a bear market, the people who are buying the dip, they fall into a pit. Basically, that is what happened. They have this buy the dip mentality. There's lack of fear. Confidence is still not low. This confidence is still high that India's story is great. Everything is good. We'll again bounce back. And then finally, we have got stage 3, the most brutal phase of a bear market. This is how a bear market actually concludes and comes to an end. That happened earlier this year. In January, February, March 2026 was when the final stage of the bear market took place. And in this again, I'll use a combination of multiple indicators. I mentioned to you how and you can understand that the bull market is coming to an end. And how do you transition from the end of a bull market to start of stage 1 of bear market? Now I'll talk about how do you know that you're entering stage 3, the final stage of a bear market. First data point or first indicator, severity of price damage. So as from September 2024 to 2nd of April 2026, any guesses what was the median fall in stock prices for companies below 3,000 crores market cap in India? Any rough guess how much they would have fallen on a median basis?
40%.
It was 66%. So 2/3 of capital was gone if you were in the small cap, micro cap space between those 1.5 years. And thousands of stocks fell 70-80%. So this is a necessary condition for a bear market to end. The prices of all the weaker business models and dubious promoters, those stocks have to get demolished. Until that froth is completely taken out, the bear market cannot come to an end. Remember that those two companies I just mentioned a short while ago, Resource Automobile and OCI Hyper Retail, who basically were able to raise money in the bull market euphoria in August, September 2024.
What happened to them?
Those two stocks fell 80-90% from the prices then. Wow. So the necessary condition that this could not happen in January, February, March 2025, because they had just fallen 25-30%. But because once you extend the time period, once this froth has been cleared out, 80-90% fall has happened in those companies, the poster boys of the previous bull market mania. That is when you know that, okay, this first necessary condition, which is severity of price damage, the removal of the froth has taken place. So now you know that you're entering stage 3, or about the new bull market is around the corner, but now you're in the final stage. The second big indicator you have to look at is the month in which the bear market is ending. It's characterized by the largest monthly FI outflow on record. If it's coupled with the worst month for the Indian currency, the rupee, in a long time, that's even better. Both these things happened in March 2026. Largest FI outflow both in stock and bond markets, and the worst monthly fall for the Indian currency, the rupee, in March 2026. You add this indicator as well to the first indicator, severity of price damage. Third indicator, there's something called the volatility index, basically which shows the level of fear in the market. In end of March 2026, this went above 25. It was even higher than the VIX level, which highest VIX levels observed in 2022 when Russia invaded Ukraine. Oil prices went up 50% very shortly in a short span of time, and there was a 30% fall in the small cap index in between February and June 2022. So the VIX in March 2026 was even higher than what it was 4 years ago. So that was another indicator you have to add, that there has to be fear in the market for a durable bottom to be made in a bear market. Fourth, you also see that the large cap stocks or the Nifty 50, that collapses or falls hard only at the very end of a small cap, mid cap bear market. To have a market bottom in place, the large caps have to capitulate. The quality large cap stocks, for example, HDFC Bank, Kotak Bank, and other high quality large cap stocks, they have to fall very hard. In January, February, March of 2026, these stocks fell 25-30%. So, and Nifty 50 in March 2026 had the largest monthly fall since COVID March 2020. So, biggest fall in 6 years. You add this indicator as well, that, okay, large caps are finally, the institutional investors, the very large money from overseas, they panic at the very, very end. See, small cap, mid cap is mainly driven by HNI retail money. They tend to panic more easily. But the institutional guys, they will only panic when they see this heavy losses on the currency, Indian currency. That is when they finally panic at the very end.
Yeah.
That is why I mentioned this after the currency point, that the currency has to depreciate. That is when these foreign guys panic, and then they start selling. So the large caps have to fall. This was the fourth indicator. Fifth indicator, most important. So when the percentage of stocks in the NSE 500 or the BSE 500 falls below the 200-day moving average, that is when you get a durable market bottom.
So when the Nifty 500 falls below the 200-day moving average,
percentage of stocks trading above the 200-day moving average, this ratio has to fall below 20%. And when you combine this with the other indicators I mentioned,
I'm confused. Percentage of stocks in Nifty 500
which are trading above their 200-day moving average has to be below 20%, which means that 80% or more of the top 500 stocks of India
should be below
have broken their long-term moving averages.
Yeah.
And they basically, they are basically trading at very rock bottom prices. So this is a very durable indicator. In fact, this indicator went below 20% in March, April 2025 last year also. But because the other conditions which I mentioned was missing, that is why that was stage 1 of a bear market. It was not stage 3, because the other indicators I mentioned were missing. So apart from these 5 indicators, now I'll mention 3 sentimental indicators. Okay. First, sentimental indicator. This is a very popular one. So the Google search trends for the term multi-bagger in March 2026, the search trend, if you just do a simple search on Google Trends for the term multi-bagger, this went below COVID lows in March 2026. So investors had lost all hope. No one was interested in the stock market. No one was searching for multi-baggers anymore.
Yeah.
Complete depressed, bombed out sentiment. Very important.
So these are alternative data points that you look at.
This is sentimental data point. You have to combine all these data points together. This is when you get, when you start seeing all of them aligning together, you know that this is the time to either raise fresh funds from new or existing investors, or just stay put. You actually become excited because you know that, okay, finally this 1.5 year of pain is coming to an end. People who don't know this, how the cycles work, they become despondent and very fearful. But if you understand patterns, then you start getting excited. Okay, now a new bull run is about to start. You actually you start looking forward. So I mentioned about this sentimental indicator of multi-bagger search on Google Trends. Along with this, you will certainly notice people, retail investors, will suddenly start abusing and blaming the government for this problem on social media. This happened in March 2026. This happened in 2018-19 bear market also, which I've talked about in my second book, The Making of Value Investor. Human nature does not change. So again, now they're starting to do the same thing. Last month they started blaming the government for the troubles. But you are accountable and responsible for your success and failures. You mature and grow up as a person when you take full responsibility for the outcome. So this is one more indicator. Final sentimental indicator. People will start saying, why are we investing in such a market like India? US is the market to invest in. Now, Ind Money, Vested, all these platforms, we don't have any collaboration with them. They started talking about, on social media that, through this platform, you should invest in South Korea, Taiwan, US, forgetting the fact that the bull run in US AI has been going on since November 2022. It's been already 3.5 years have passed. Now you're trying to get in at peak profitability, peak margins, peak valuations. What's going to be, the odds are now stacked against you. You want to, on the other hand, the odds in India was stacked in your favor because 1.5 years of price damage has already happened. Stage 3 has just ended. And how do I know that the bear market in India ended on 2nd April specifically? On 2nd April, I know this, listen to this very carefully. On 2nd April, there was a big gap down, big fall in the morning on opening tick, 9:15 a.m. But thousands of stocks down more than 3%. But by the end of that trading day, most of the stocks had flipped back into the green. So there was complete exhaustion of sellers, exhaustion of selling. This is when you know that, okay, even the sellers have become tired now. Now there is no sellers left. This is, you have to look for that big reversal day. It's not a day when just market just go up. You have to have a big reversal day for a durable bear market bottom to take place. This is how you identify that you're in stage 1 of a new bull market. And that's why what I feel that you'll see there is a saying that bull markets climb a wall of worry, right? In bear markets, when bear market is going on, stocks and markets will not react to whatever good news comes. For example, I mentioned last year, RBI cut interest rates by 125 basis points in calendar year 2025. Governments made income up to 12 lakhs tax-free. Government reduced GST rates and rationalized. Again, big boost there as well. We had very good monsoons. All the good news was ignored by the market. Why? Because we were in a bear market. Now see what's happening. The war is still not over. We have had a very fragile ceasefire. Now the US has started blockade of ships going out from Iran. That's even worse news. But markets do not react negatively to the same bad news twice. Markets respond to the intensity of the bad news and the delta or the rate of change of a bad news. Unless this war escalates, unless anyone goes nuclear, from here on, even though you'll see both the sides engaging in clashes, if the incremental clashes between US and Iran is not more than what they have already done in the last month, and I feel both the countries are not tired of fighting. They've already done so much damage to each other, and they are not getting tired. The public of US especially is now getting tired. They are like, get us out of this war. We didn't want to do anything with this war, right? So as long as the incremental news flow regarding the war does not get worse from here, I think market will we'll see that that market is just shrugging off all the news which is coming from on the war side.
Yeah.
Unless there's some new war which breaks out, or China, Taiwan something happens, or some new big negative thing happens, and unless the oil goes up again to 120, 130 or more and stays there for a sustained basis, I believe this new bull market has started in India, and this is the time when you want to allocate smartly as an individual investor and active fund manager into what you feel is going to be the new sectoral leaders now.
So when you can accurately determine that we are entering a bear, what do you want me to do that time? Like, if I can predict it based on what you said, what is the action I should take? Like, should I try to time it and pull out the money? Like, how would you advise me?
I will tell you what I would do from now on. Earlier, I used to take a cash call, but I think going forward in future, once I get a sense that we are entering stage 1 of a bear market, I would not mind getting my fund into 20 or 30% cash. Let's say 30% cash I've come into. Now I'll tell you why this is important for fund managers. Let's say that the portfolio falls 20% in a bear market, okay, over 1.5 years. So 20% of 30% cash call is 6. You've straight away added 6% alpha to your clients right away.
Yeah.
And everyone earns beta in a bull market, Sharan. But true alpha is generated only when you're in a bear market.
Yeah.
That is when basically if you see all the successful fund managers, they are the ones who are able to generate alpha or survive bear markets, because it's very easy to enter this profession during a bull market. But the people who really sustain and survive over the long run and thrive in the stock market are ones who can actually survive bear markets. That's why I wrote my second book. The subtitle of the second book is What a Bear Market Taught Me About Investing.
Got it. So now let's talk about, the sector rotation strategies that you were talking about. The strategy that we need to follow in the stage 2 of the bull market, which you're saying we're about to enter right now. So what are the frameworks that I should keep in mind? What are the sectors that I should look at which have strong tailwinds, which you have analyzed and which you are personally looking at right now?
If you want to be successful as an investor, Sharan, you have to make friends with the word new management, new industry segment, new product vertical, new government catalyst. There has to be some big catalyst or something new has to be there for a sector to be a leader in a new bull market. For instance, previously, prior to 1 year ago, India was often criticized by world leaders for not being very trade friendly. We never used to do bilateral trade deals. But in India, I always tell my friends and colleagues and investors that India is a country which always autocorrects after every crisis. India is a country, be it the Congress government or the BJP government, we have always acted or taken hard reform steps only during times of crisis. Last year, when Donald Trump imposed a 50% tariff on India, 25% trade tariff plus 25% penal tariff for importing oil from Russia, it was effectively a trade embargo. We could not export to the largest consumer market in the world because exports collapsed, dollars stopped coming into the country, the rupee started depreciating. It was a crisis, basically a crisis. That spurred the Indian government into action. And we have signed, since then, we have signed a plethora of bilateral trade deals with countries like UK, Oman, New Zealand. Recently, the mother of all trade deals with European Union. After so many decades, finally this happened. We also signed a very good trade deal with America as well. This is the first thing which I just mentioned to you, new. This is new, something very big and new. Now you want to look for where does India, compared to Vietnam, Philippines, Bangladesh, where do we actually have an advantage over these countries? Okay, we cannot compete with China in low skilled labor. That's very difficult. But in industries where very highly skilled labor is required, for example, precision engineering exports. This is where I think we are going to find the next set of market leaders. I'll give you a simple example. There are there are auto companies and in particular auto ancillary companies. If you can make an auto ancillary, you can basically easily use your existing skill to venture into making parts for defense and aerospace industry as well. So precision engineering exports, aerospace, after many decades, Airbus and Boeing, the two dominant, airline companies, now they are basically finally starting to outsource to India, finally after a long time. And there are just a few select handful of companies in India which have the capabilities of being a tier 1 or tier 2 supplier to these two big giants. I think aerospace, precision engineering exports driven by this FTA signed, this will do very, very well. Along with this, something very interesting is happening. I mentioned the word new to you. AI is new, relatively new, right? AI is compressing the timeline for clinical trials in pharmaceutical industry. The timeline for drug discovery is getting compressed very, very sharply. It's becoming shorter. So the challenge now is not drug discovery. It's about having the necessary compliant manufacturing capability to manufacture these drugs for these large, big pharma companies of the Western world. And India, again, has got a big advantage. We have got this industry, again, requires very highly skilled labor and scientists. And there are certain CDMO, or true CDMO companies, contract development and manufacturing organization companies, which works with innovator pharma companies, not generics, not the low margin commodity generic companies. These are companies which are working with innovator large pharma companies of the Western world. This is again an area which I think will lead over the next few years in India. So innovator CDMO, auto ancillaries, especially those with capabilities for going into defense and aerospace industry separately, and innovator pharma. I think these industries will do pretty well. In addition to this, power related ancillaries. This is a segment I'm very bullish on because this is the single biggest bottleneck today in AI, power, energy.
Yeah.
So if you can find companies within the data center value chain and power industry value chain, which can solve this problem, that is also going to be a bull market leader in my view. And how do you know that? How I was able to shortlist all these sectors? These were the very sectors whose leading companies and strong companies their stock prices were actually rising in March 2026. When there was a big crash in March 2026, these stocks were actually rising or they were flat. That is, but you don't just buy a stock because you see the price is not falling. That is where the actual grunt work, the hard work begins for active investors like us. Then we open the latest annual report, the last 4 conference call transcripts, the last few presentations, press releases. Look at the past track record on tools like Screener.in or Tijori Finance. This is where the actual work actually begins. Initial screening part is easy, but then you start going deep into each company and then investing in those companies where you have relatively good valuation entry point and which falls within your circle of competence.
Okay, so essentially your sector allocation is mostly towards new age businesses which are going to benefit from the macroeconomic changes that's happening in the country. So you're not in financials, not in consumption, not in automobiles.
Automobiles, we are playing it through auto ancillaries.
Healthcare you mentioned through
Innovator CDMO.
What about IT? All of these sectors you don't invest in.
Let me talk about IT right now. So for last 25 years, since 2000, Indian IT services has primarily been a headcount driven model. You hire more people, earn more revenue. Simple. What is AI all about? Removing headcount. Now, basically, a single person who's good in AI can do the work of 20 people using AI tool, right?
TCS has still reported good revenue recently, even though AI.
In fact, in the most recent, in Q4 of FY26, TCS, for the first time since its listing in 2004, reported year-on-year negative constant currency growth in dollar terms for the first time in 22 years.
Okay, in dollar terms, it is negative.
That is the key metric you want to look at, the dollar constant currency revenue growth year-on-year. For the first time in 22 years, Sharan, TCS, the bellwether of Indian IT, has reported a negative year-on-year growth. Look at what has happened to the Indian currency versus the euro. While the Indian currency fell 12% against the US dollar over the last 12 months, do you know how much the Indian currency has fallen versus the euro in the last 12 months?
About 25%.
25%. Yeah. So if you are a FII or an institution based in Europe, you will not look at India again for many, many years. You're out.
Yeah.
Because 1/4 of your capital just got destroyed just by currency crash in India.
So now going to Europe will be very expensive for us.
It's going to be very expensive. That's why you should, apart from INR investments, so you should try to also invest in a hard asset or a hard currency. For example, a USD based investment or something like gold, which basically gives you the benefit of rupee depreciation every year. Or you can through IndMoney, Invested, all these different platforms, you can also look at how you can make USD investments. It's very important to preserve your purchasing power.
What about new age internet commerce companies, internet marketplace companies like Zomato, Swiggy, Urban Company? These guys have no competition, huge barriers to entry, pricing power. You don't look at these companies?
You mentioned Blinkit. There again, so much competition is coming in. Amazon is entering the space. Flipkart is entering the space. Again, it's basically there's a concept called capital cycle in the stock market. Whenever any industry starts attracting a large amount of capital, you can expect the future profitability of the incumbents and existing players to get impacted. That is when you basically need to be cautious or take an exit. So basically, I try to avoid competition. The Warren Buffett again has said that the secret to life is weak competition. So this is something which I like to focus on. The lesser the competition, the better. In investing, you do not get points for degrees of difficulty or complexity. Investing is all about trying to maximize your returns over time with the lowest amount of risk. And you don't have to this is not like the Olympics, but you have to just try to do something very difficult. You just want to go for the easy route. Let the other people people in highly competitive industries fight with each other while you make money in less competitive industries.
So you mentioned about the need of investing in the US, but you also said that the AI boom has been going on for a while now. The bull market of US has been going on for 2-3 years. And now there's a lot of interest from Indian investors to invest in, US companies.
Recency bias, yeah.
Recency bias. So would you say that is the wrong thing to do right now? Should we sit on cash with our US portfolios right now? You think it's too much heated up?
No, I'll give you a data point here. See, it should be data driven at all times. So Anthropic, one of the frontier models there, basically just in the month of March 2026, their annual revenue run rate from a few months ago, it was $9 billion annually. It is now they've hit an ARR of 30 billion, which means that the enterprise AI use case is now clearly getting established. We are just on the verge of the exponential takeoff. As enterprise AI adoption scales up exponentially from here, there are certain pockets within the value chain of AI, where you basically want to now focus your efforts on. So, just don't focus on the Magnificent Seven. You have to basically see where the industry is evolving towards, and which are going to be the new beneficiaries from this
Yeah.
during this exponential adoption phase.
Yeah.
Earlier, basically the first phase was driven by compute, NVIDIA.
Yeah.
Required a lot of compute to train these models. NVIDIA did very well.
Yeah.
Now the hyperscalers are basically diversifying their and they're also backward integrating. Google through their TPUs or Amazon through their in-house chips. Basically, now they are trying to diversify away from NVIDIA.
Yeah.
So that is not where you want to focus on. You want to now focus on which are going to be the new beneficiaries of this new inference cycle. Inference basically is that now you ask AI a question and basically it just it has to recall everything and give you the answer back. So now look at certain pockets within the memory chain, for example. Maybe they'll do very, very well from here. Agentic AI took off a few months ago, and because of that there's suddenly an explosion in CPU demand.
Yeah.
So AMD and Intel, these are not stock recommendations, I don't have positions here, but they too may do very, very well from here because they are predominantly in CPUs, AMD and Intel. In fact, Intel recently just it's very close to its stock price, which was seen last in year 2000. So if any company stock price breaks a 26-year high after a long time, it doesn't stop at just 10-15%, it goes vertical after that if the fundamentals improve. So these are stocks to look at.
I think, Gautam, I'm your fan now. I think I have not learned so much in a span of 1.5 hours. I think, Gautam, before I let you go, I want to ask you a quick questionnaire on our rapid fire round. So are you ready?
Sure. Let's go for it.
Okay. Question number 1. If you had to put all your money in just one sector right now, which one would it be?
Power ancillary.
One asset class you would completely avoid right now.
One asset class I would any asset class which is overblown. For example, if you had asked me this question in January, I would have mentioned gold and silver because there was complete euphoria. Any place where there is euphoria about that asset class.
So now gold and silver is still okay or no?
I think in the long run there is a a trend of de-dollarization. So gold may still do well over time, but silver is very volatile.
Yeah.
That is something I would avoid.
Okay. One global market apart from US, which retail investors should look at. You can say nothing also.
I would say Europe, and within Europe again, not all the not the Europe ETF, but Europe is rearming itself, just like Canada is doing the same. So European defense sector is something which you can definitely look at.
Okay, European defense sector.
Because NATO is in jeopardy, and if NATO collapses, then Europe will have to spend hundreds of billions of dollars on improving their defense capability.
Tell me the most underrated thing in finance that most people miss. Like I'm talking about normal retail investors, not experts.
That you can still, you can buy an expensive looking stock and still make money. It all depends on which stage of the company life cycle the company is in. If it's in the early growth stage, even if you pay a high P multiple, you'll still make a lot of money. But if you buy a high P stock in the decline phase of a company, then you will lose money.
Tell me 3 favorite books of yours which you would recommend every finance enthusiast to learn from today.
The first book I would recommend is Poor Charlie's Almanac. It's one of the best books on multidisciplinary thinking, which contains Charlie Munger's thoughts. And the second book I would recommend is Seeking Wisdom by Peter Bevelin, one of the best books again on multidisciplinary thinking. The third book I would recommend is called All I Want to Know is Where I'm Going to Die, So I'll Never Go There. It's again by Peter Bevelin. It's the best book on the topic of inversion. Inversion basically means that once you know what to avoid in life, business, relationships, and investing, then you automatically arrive at what you need to do, what you should do.
And tell me a book that changed the way you thought about life, not just about investing, life in general.
Die with Zero by Bill Perkins. It's the best book, one of the best books I've read in a long time. In fact, the lesson from that book was, Sharan, that life has got an expiry date.
Yeah.
But enjoyment in life should never have an expiry date. So once you make it in life, then you should definitely pursue your passions and live life to the fullest. Don't pursue delayed gratification endlessly. You have to because your time on this planet and this world is limited, right? So you should just try to make yourself as happy as possible.
What is the highest returns you've made in a single year?
In a personal capacity in 2017, I remember in my personal account I was up more than 100%. So that was the biggest year.
And
for
the
sure.
most amount of money you lost in a single year?
That was in the year 2018. It was in a stock called Bandhan Bank. I remember that stock. It was a very big allocation, and they had a big crisis in their asset quality because of problems in Assam and West Bengal. So I lost a lot of money in that stock.
Like, can you talk about percentage dip?
I remember 60%. I sold it at 60% down from the top price. High price.
You would call that as the biggest mistake, finance mistake.
Biggest, yes, for sure. Because there was a reason for that. There's something called liking bias. There was a book called Bandhan, The Making of a Bank by Tamal Bandyopadhyay, in which Chandrasekhar Ghosh, the founder of Bandhan Bank's story was written. I got very emotionally attached to the founder without understanding that you have to separate the stock and the promoter from the economics of the business. You have to remove your liking for the promoter from the economics of the business. If the economics of the business is getting disrupted, you should take a dispassionate exit. So you have to have this approach of not getting too attached to stocks. Don't get married to stocks.
Perfect, Gautam. Thank you so much for coming here and explaining to me like I'm 5 about how the world works, how investing works, how finance works, and how you importantly look at the future of where the alphas are going to be created. Thank you so much for patiently sitting and explaining to me and all the people who've been watching until the end. And I look forward to talking to you once again, and I'm sure I'll keep calling you up for any doubts and questions that I have. If you have time, please pick up my phone.
This was a pleasure, Sharan. Thank you so much for having me.
Thank you so much. Guys, thank you so much for watching till the end. Please feel free to drop any questions in the comment section which you feel like I missed out on asking. That will help me become better at what I do. And please feel free to drop any guest recommendations down below so that I can try bringing them on the next one. On that note, guys, I'll see you in the next one.
Before you go, guys, if this video gave you even one insight and made you feel differently about money, don't just keep it to yourself. Share it with your friends or family member who could use it too. And if it has sparked a new thought or even made you disagree with me, drop a comment below and tell me why. Your critique helps me make this conversation sharper and more useful for you. As long as you have me subscribed, I'll make sure that you walk away with one new thing every Wednesday and Saturday.